Most investors accidentally pay more tax than they need to, not because of how much they earn, but because of where their portfolio grows. Only a select few investors have been let in on the tax-free conversion secret, and now you're one of them. They stash their highest growth investments where the IRS can't touch them, and they keep their stable assets right where taxes will do them less harm. I'm Ron Bristol with Advanced Wealth Advice with another personal finance hot take. Today, I'm blowing the lid off the most underused method to grow the part of your portfolio that the IRS can never take a bite from: tax-free Roth conversions. And there's no way you're ever going to hear this from the IRS. A couple walks into my office with a color-coded spreadsheet. They're doing everything they've been told to do: maxing out accounts, diversifying their portfolio, rebalancing, and Roth conversions. But their plan is quietly sabotaging their future tax bill. Their advisor used a very reasonable model portfolio across all of their accounts and cost them taxes that they could have avoided. To fix this, we don't have to change any of their investments. We only need to change where each dollar lives. We put high growth investments in tax-free accounts. The long-term result: the same effect as doing Roth conversions without having to pay tax on them. More tax-free growth, lower required distributions, less Medicare drama. Same portfolios, different homes. Get the asset location right, and conversions can feel tax-free when your highest growth investments compound where the IRS has zero claim on them. Back to the couple in my office. They've got several things: a core exposure sleeve using standard large company mutual fund and index funds, a high growth sleeve invested in small company stocks, technology and innovation funds, and private equity exposure, and a stability sleeve in high quality bonds, short duration fixed income, and cash-like reserves. All of this held in very reasonable amounts, identically across all of their accounts. But let me ask you this: if you have one account where you will eventually have to pay taxes on the growth, and another account where you will never pay taxes on that growth, which account do you want to grow? Of course, your answer is the tax-free account. So we simply swap the homes where each type of investment resides. We sell the slow and steady growing funds in their Roth IRA and buy the highest expected growth positions. We sell the high growth and dividend paying investments in their traditional IRA and buy stable, lower return assets. Then we make sure their taxable account has tax efficient equities and strategies that play nicely with capital gains. Same risk, same allocation, way lower taxes in the future. And we can do all of this without creating any more tax right now. The takeaways are these. The Roth is your growth sanctuary. That is where you want your high growth investments. The traditional IRA is a deferral tank. Put your steady, low yield assets there. And you don't need to take more risk. You need to place the same risk more intelligently. We help clients redesign placement in our working sessions. If you want a second set of eyes, there's a link in the details of this video to book a call with us. Now you might be thinking, how much can this really save? Well, probably more than you realize. Let's look at some real numbers. Dan and Leslie have a $600,000 retirement portfolio, and they've done a nice job converting some of it into tax-free Roth accounts. 400 of it is in traditional IRAs, and 200 of it is in Roth money. Their current advisor uses the same model portfolio on both accounts, and that grows on average at 9% a year. Over 10 years, it will grow to over $1.4 million, with $475,000 of that being tax-free Roth money. Now, Chris and Jen have the same exact portfolio, but get the investments into the right homes. Will still make 9% on average overall, so their total will still grow to the same $1.4 million. But we'll get 7% growth in their traditional IRA because we place all of their stable investments in that account, and we'll get a little over 12% in their Roth IRA because that's where the high growth investments reside. The Roth will then have over $630,000 in it after 10 years. So effectively, they've done $160,000 worth of Roth conversions without paying a dime of income tax on them. I know I'd rather have more tax-free money, especially if it doesn't cost me any more in taxes. Well, you might be thinking, I've used my advisor for years. Why are they not doing this for me? Look, I don't blame them at all. They're probably very focused on managing your investments. I advised clients the same way for years before I started digging into the long-term tax implications of retirement income. This topic is a bit too complicated for the financial press to write about, and the IRS certainly does not want you to know how to do this. The bottom line is that you don't need a new portfolio, although you might, but you certainly need a new blueprint. Make your conversions feel tax-free. Put your highest growth where it won't ever be taxed. We create this new blueprint and put it into action for you. Want to know how it would look for you? Click through the scheduling link in the details of this video to find some time on our calendar for a free initial consultation, or watch the free video to learn how we work with clients. You can also feel free to explore our website, advancedwealthadvice.com, to learn more about us. Thanks for visiting our hot take videos. I hope that you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.